All right, so we were just looking at the odds, how traders are pricing in a cut for that November meeting. It actually increased from yesterday after we got that hotter than expected CPI. I want to ask you, are you surprised at all about that? But remember, we also got initial jobless claims that came in hotter than expected as well.
I was surprised in that both of those numbers would actually at least start to point toward a pause. And we know from the minutes that this wasn't exactly, the super jumbo cut wasn't, all hands were, raised for that. And so you do have to think that there has to be more wiggle room. The markets are just not priced for it.
Yesterday, we also heard from Raphael Bostic saying he was okay with a pause. In your mind, if we do get that pause, what does that do to the markets? Does it impact certain sectors more than other sectors, or does it just hit the markets broadly?
Well, I think it hits the markets broadly. I will say that, we're about to get bank earnings, and, the banks have been suffering under this, inverted yield curve that feels like it's been going on forever, and we were starting to see that unwind. And so, a slightly better outlook on the economy, plus the Fed, cutting, that should have righted that yield curve. So you have to wonder, if we do get a pause, what does that do to the outlook for banks if they have to suffer farther?
It sounds like you're talking about net interest income, net interest margin. Is that the metric that you think is going to be hit by that?
Yeah, it's been hit for the last 2 years.
Right.
So without a doubt.
What about rising rates on other activity, things like the IPO market, capital markets overall? I mean, are you concerned that if these rates stay elevated, as we're seeing right now, the 2-year just pulling back from 4%, but a lot of this week it was actually above 4%, and the 10-year has been moving higher. I'm looking since the rate cut, the 10-year's moved up 35 basis points, the 2-year about 40 basis points. Are you worried what that does to even other parts of their business, or is it just generally that net interest income story that concerns you?
Well, no, there's definitely a bigger play here. I do think that rates going up, part of that is healthy. So you don't necessarily want to see this inverted yield curve forever. And so Treasury rates getting up above 4%, you could argue, probably restores, some positive outlook, even if it's also pricing in more inflation. But there is a huge concern that the IPO markets need to open up in order to sort of get capital flowing again. Anybody who's been raising capital this past year can tell you that it has been very, very difficult to sort of find money to make investments, and that's a big challenge, and interest rates are a big component of that.
Absolutely. One other thing I want to talk to you about. Yesterday, the 2-year anniversary of the bull market, our Jim Cramer highlighted some of the stocks that led us higher. We're going to show them NVIDIA up 1,000%, over 1,000% since that time. Supermicro, Vistra, Palantir, also Fair Isaac. You have to go to CNBC.com to see the ones that he says he would buy now and put money in now. I just want to get your take on some of these stocks. Would you put money in any of these stocks right now that have had these huge run-ups? I mean, what do you just think about these stocks that have really led us?
So much of it is really built on the question as to whether or not the AI play is going to pan out in that sort of long super cycle kind of way. I actually do think that there is a super cycle to be had here, but I also think it's been priced in. And so whether or not you're going to get incremental value on the marginal dollar invested today after 1,000% rise in NVIDIA, I think that's more of a challenge. And if anything, we think that we're potentially setting ourselves up for, continued volatility with, the election, the process that happens after the election, geopolitical risk. There's a lot of risks out there that could put volatility into the market. And we've been rallying like nothing is happening anywhere else in the world. And I don't think that you can necessarily bank on that holding. So we've actually been hedging with options all through this.